We're jumping straight into Nebius Group today. Everyone is watching the price volatility, which has been pretty intense. But the real story, I think, is hiding just underneath. It's the sheer scale of the operation. We are talking about genuine hypergrowth.
Oh, absolutely.
355% year-over-year revenue growth in the third quarter of 2025.
And that's just the headline. It's driven by that core AI infrastructure business, which grew, what was it, 400%.
400%. So our mission here is to really understand the situation. How can a company reporting, massive net losses also be sitting on potential revenue of around $7 billion?
And backed by concrete contracts from, the biggest players in the AI race.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us. If you're enjoying the show, make sure to subscribe and hit the like button. It really helps the channel. And definitely let us know in the comments which stock you want us to simplify next.
All right, let's look at the overwhelming bull case for Nebius Group right now. And if you have to distill it down to one single concept, one word, it's capacity.
Capacity.
It absolutely is. This is a pure play in AI infrastructure. So they're focused entirely on providing the high-powered compute. We're talking advanced GPUs, specialized data centers.
Everything you need to train and run these large language models.
Right. And they have completely sold out their future compute availability. That is a huge strategic advantage.
So let's get granular on the numbers that show this. Q3 2025 revenue hit $146 million.
Which is impressive, yeah.
But the real narrative driver is that 355% year-over-year growth rate. And when you look closer, the core AI infrastructure piece, it isn't a side business. It accounts for nearly 90% of total revenue.
And that specific segment grew 400% year-over-year. That's not normal growth.
No, that's geometric expansion.
And what's so crucial here is to recognize why that's happening. Management has said repeatedly that their growth is limited only by how quickly they can physically build data centers and get the GPUs to bring capacity online.
So demand is just off the charts.
It signals a situation where demand far, far outstrips supply. In a normal market, that's just high demand. In the AI compute market, that scarcity creates an incredible competitive moat.
Right. They're capacity constrained, not demand constrained.
Exactly.
And this brings us to what I think is the biggest differentiator. Customer concentration. Usually, having all your eggs in a couple of baskets is seen as a major risk. But here, it's actually a strength.
Because of the scale of the commitments, we're looking at multi-year, multi-billion-dollar contracts. These lock in capacity for the foreseeable future.
How big are we talking?
$3 billion committed from Microsoft, another $3 billion committed from Meta. And these aren't just handshake agreements. These are binding multi-year capacity reservations.
So that completely changes the company's profile. It stops being just a volatile growth stock.
It becomes a quasi-utility for the AI giants.
Yep.
Exactly. That $6 billion in mega deals just transforms their revenue visibility. They know exactly when that revenue will ramp up, which lets them make these massive investment decisions with a really high degree of certainty.
And it's sticky, right? Switching providers at that scale must be a nightmare for a hyperscaler.
It's intensely costly and complex. So those contracts, they act as a massive structural barrier to entry for any competitor.
And if you look at their balance sheet, this is where you find this kind of financial paradox that supports the whole story. Despite operating in what is maybe the most capital-intensive sector right now, building data centers, buying GPUs, they maintain an unusually strong financial position. We saw a net debt position of negative $2.4 billion.
And that negative net debt figure is so significant, we should probably define that. It doesn't just mean they have little debt.
Right.
It means their cash equivalents, marketable securities. All of that exceeds their total debt by $2.4 billion. They have a huge cash buffer.
Which is just so rare for a company that's expanding this aggressively.
It demonstrates the incredible contractual certainty those Microsoft and Meta deals provide. They have the cash to fund the growth without immediate distress.
It gives them a huge operational advantage over smaller players who have to run to the market for every single expansion.
And while a lot of investors see high growth and just assume, guaranteed losses, the unit economics are already proven.
Oh, yeah.
While the overall group EBITDA is negative because of the sheer cost of building everything, which we'll get to, the actual core infrastructure business is generating significant operational leverage.
What kind of leverage?
That core segment achieved an adjusted EBITDA margin of nearly 19%.
Okay, so explain that for us. What does a 19% margin in the core business really tell us?
It tells us two key things. First, the pricing is highly favorable. They're charging a premium for this scarce compute.
Sure.
Second, once that initial high-cost investment in hardware and construction is made, the incremental cost of servicing those contracts is, well, relatively low. The business model is highly profitable at its core.
It's just being masked by the enormous, deliberate, front-loaded capital expenditures.
Exactly. Once those CapEx cycles slow down, that 19% margin, and potentially higher, is going to flow directly to the bottom line. It validates the whole long-term profitability thesis.
That really paints a powerful picture. The bullish capacity advantage, the secure contracts, it's all there. But that fortress balance sheet we just talked about, it's about to be put through the ultimate stress test. So let's look at the other side of the coin, because the narrative gets tricky right where the company is deciding what to do with all that cash. This is where the risk is.
Right, and it immediately raises the question, how do you fund a 400% growth rate? And how fast do you have to move? The answer is through staggering capital expenditure, CapEx.
And we saw this in the filings.
Nebius Group raised its 2025 CapEx guidance from an already high $2 billion to an aggressive $5 billion.
$5 billion.
Yeah.
In 1 year. For a company this size, that's not tech company spending. That's, I don't know, a major utility.
An oil and gas giant, yeah. And this money is all dedicated to one thing, getting GPUs and building the data centers to house them.
And that massive investment is the direct cause of the financial pain we see now. It drives that deeply negative free cash flow.
And we saw the tangible result in Q3. The company reported a net loss of $119.6 million.
And that, of course, is what triggered the market nervousness and the stock volatility after earnings.
Of course. It's a necessary point of analysis.
So how does management justify burning over $100 million in 1 quarter to its investors?
They see it as a deliberate strategic choice. It's a land grab. In the current environment, high-end GPUs are the real bottleneck to AI development.
Right.
So by sacrificing near-term cash flow and spending like crazy now, they're essentially printing market share. They're securing contracts that will generate high-margin revenue for years.
The risk, of course, is that they're betting on executing this perfectly and quickly. If the revenue ramp stalls or if the GPUs don't show up on time,
then that cash burn stops being a strategic choice and becomes a severe financial liability.
And to finance this, they need some creative solutions. They're using an at-the-market or ATM equity program.
Right, for up to 25 million Class A shares.
Explain the ATM program.
It's important because it's a continuous dilution strategy, not just one big financing round. A traditional secondary offering can be really disruptive. An ATM lets them just drip feed shares into the market when the price is favorable.
So it gives them flexibility.
Flexibility, yes, but it introduces consistent share dilution risk. This constant potential for new shares can pressure sentiment, even if the capital is absolutely necessary for growth.
And we've also seen some noise around insider sales. I know they can be routine for tax management or whatever.
But in a stock this sensitive to dilution and volatility, they just add temporary selling pressure. It increases skepticism. You have to have really deep conviction in the long-term story to look past it.
So if we zoom out from all these financial maneuvers and connect this to the biggest picture, the single largest variable, the crux of the whole thing is execution.
This is the $7 billion question, literally. The company has set an extraordinarily ambitious 2026 annual recurring revenue target.
Which is?
Between $7 billion and $9 billion.
Let's just pause on that number, $7 to $9 billion. Given their current run rate, that requires, what, a 7 to 9x expansion in a single year?
That is the highest level of execution risk we can possibly discuss. It's not about signing contracts anymore. The contracts are already signed. This is all about logistics, supply chain, construction efficiency, rapid deployment.
It's all in their ability to get those $5 billion worth of GPUs and get them online for Microsoft and Meta.
Everything rests on that.
So what happens if they miss? Say they only hit, I don't know, $4 billion or $5 billion.
Missing the target significantly, even $4 billion is still massive growth, would likely trigger a substantial correction in the stock. The valuation is pricing in near perfect execution of that $7 to $9 billion target.
Because it's all based on the contracted revenue.
If management signals that deployment is slowing or the supply chain is hitting friction, the market will re-rate the stock rapidly. The high-growth story demands flawless execution.
So given this high-stakes environment, this balancing act between hypergrowth and massive execution risk, what are the immediate indicators and technical levels that you need to be following right now?
We need to translate that risk into price action. Let's look at the trading behavior. The stock is characterized by extreme volatility, which is reflected in its high beta of 3.83.
Walk us through what a beta of 3.83 actually means for someone watching their portfolio.
It means that statistically, if the broad market, say the S&P 500, moves up by 1%, Nebius Group tends to move up by almost 4%.
And the reverse is true too.
And conversely, if the market falls by 1%, this stock can fall almost 4%. It magnifies everything. This high volatility is a clear sign that the market sees this as a high-risk, high-reward bet.
Technically, the stock is up over 200% year to date, but we have seen a recent pretty sharp 30% pullback. It's been consolidating in the, 83 to 87 $87 range?
Yeah, and that consolidation phase creates a clear technical structure we need to watch.
Okay.
Critically, the crucial support level has been the 200-day simple moving average, right around $83. For a lot of institutional investors, the 200-day is a key line in the sand.
It's a long-term trend.
Exactly. And the fact that the price is held above that level despite the pullback suggests ongoing institutional accumulation. Big funds are using the volatility to build positions.
So stability around $83 confirms that institutional faith. What confirms a return to the uptrend?
On the upside, for that primary trend to really resume, we need a convincing, sustained break above the $100 or $110 resistance zone.
That's the psychological barrier.
It is. Clearing $110 would signal that the fear over dilution and execution risk is receding, and that investors are starting to confidently price in the successful 2026 revenue ramp.
All right, finally, let's talk about the calendar. What is the most critical catalyst that you need circled?
The calendar is all about validation. The single most important event is the Q4 2025 earnings release, which should be late January 2026.
And it's not just about the Q4 numbers.
No, the market's focus will be almost entirely on forward guidance. They will be scrutinizing management's tone and confidence about validating that huge 2026 ARR guidance, that $7 to $9 billion target.
So we're looking for a detailed status update on these massive deployment projects.
Precisely. Investors need specific, positive updates on the progress with Microsoft and Meta, GPU deliveries, data center completions. Any sign of delay is going to be magnified.
So the general sentiment seems to be cautiously bullish.
I'd say so. The high price targets reflect this belief that the upside potential from owning this AI bottleneck is just too great to ignore. They're betting Nebius has secured its essential role.
And the only thing standing in their way is how fast they can deploy the resources they already have the cash for.
It's a classic high-stakes venture capital model just applied to a public company. They are trading guaranteed near-term profit for the potential to capture irreversible market dominance.
That's the lowdown on Nebius Group for today. This company is the quintessential AI pure play, trading the safety of near-term cash flow for the potential dominance of the next technological cycle.
And if we connect this to the bigger picture, the question isn't whether AI infrastructure demand is real. It clearly is. They are selling everything they can build. The real fundamental question you need to ask yourself is this: can Nebius Group's logistics and management team truly pull off a 7 to 9-fold increase in revenue in 1 year, or is that extraordinary target the ultimate Achilles heel? Your confidence in their ability to execute that infrastructure miracle is the single most important variable in this whole investment thesis.
If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.